So let's start our next chapter, PGBP. Hi, this is CA Reshma Jain here. We are going to start a summary and revision of the chapter PGBP. Now, what does section 145 says? Any method of accounting, cash or mercantile system of accounting which the SSC regularly and consistently followed, and on basis of that income will be taxable under this head. Income chargeable under this shall be computed in accordance with the method of accounting which is consistently and regularly followed by the SSC. Now, what all comes under the topic under the head profits and gains from business and profession. So, first is the normal point. Profits and gains of any business or profession will come under this head. Okay. Income from house property, the rent we are receiving will go to income from house property, will not be covered here. Suppose we are getting rent from the house property, then it will go to IFHP. Suppose any contract is altered, terminated or modified, and because of that we are receiving any compensation, then such income will be taxable under the head PGBP. Income derived by trade, profession or similar association from services performed for its members. Suppose a trade or associations are performing services for its members and the members are paying fee for that, then it will be taxable under the head PGBP. Now, in case assessee is carrying on an export business and while exporting he is receiving certain benefits, right? If he is exporting, suppose he is selling the input entitlements, the profit which he is getting will be charged under PGBP. Suppose he is getting any duty drawback, that will be chargeable as PGBP. And he is getting profit on transfer of duty entitlement passbook scheme or duty free replenishment certificate, all such profit will be charged to PGBP. Now, value of any benefit or perquisite arising from business or profession, whether convertible to money or not, in cash or in kind or partly in cash or in kind, will be chargeable to PGBP. Now, perquisites given to employee will be charged under the head salary, but in case of perquisites from business or profession will be charged to PGBP. Interest, salary, bonus, commission, remuneration received by partner will be charged to PGBP. However, to the extent allowed as deduction in the hands of the firm. However, partner's share of profit will not be taxable in the hands of partner. It is exempt from tax. And any non-compete fees received. Non-compete fees, that is, I am agreed I will not open a similar shop in the nearby locality, or agreeing to not sharing any know-how with any other person. This non-compete fees is also taxable under the head PGBP. Any sum received under Keyman insurance policy. Now, any sum received under Keyman insurance policy by employer, if it is received, it is under PGBP. If it is received by employee, it will be taxable under the head salary. Now, what happens is, when a stock in trade is converted to capital asset, FMV of the capital asset will be taxed as PGBP. Any sum, whether received or receivable in cash on account of capital asset. Now, when we bought a capital asset, the capital asset would have, and we have claimed 35 AD deduction, 100% deduction. So, when we are selling such capital asset, the entire proceeds will be taxed as PGBP. We cannot get benefit of cost of acquisition because we have already claimed as deduction under PGBP. Okay, all these will come under the head PGBP. Now, moving on, what is speculative transaction? We should know what is speculative transaction because we have to separately calculate the profits from speculative business and other business. Why? Because speculative profit can be set off only against speculative profit and loss only from each other, and speculative loss can be carried forward only for 4 assessment year. So separately calculating speculative profit and loss is important. Now any transaction in which there is a purchase or sale, but it does not include actual delivery or transfer of the commodity or scripts. There is a trading, but there is no actual delivery. Suppose intraday transaction, take for example. So there is no actual delivery, but trading is happening. Such transactions are called speculative transactions. However, these transactions will not be treated as speculative transactions. Hedging of contracts in respect of raw material or merchandise. Hedging of contract in respect of stocks and shares. Forward contracts. Trading in derivatives in a recognized stock exchange. Trading in commutative derivatives in a recognized stock exchange, and chargeable to commodity transaction tax. So commutative derivatives should be in a recognized stock exchange, and it should be subject to CTT. Then it will not be treated as speculative transaction. But condition of CTT is not applicable in case of agricultural commodity derivatives. Suppose we are dealing in agricultural commodity derivatives in a recognized stock exchange and we are not paying CTT. Will that be speculative transaction or not? It is not a speculative transaction. So, hedging contracts for raw material, merchandise, stocks and shares, forward contracts, derivatives, whether commutative derivatives or otherwise. So, we will compute the income from business and profession in accordance with these sections. Now, there are admissible deductions, section 30 to 37. Inadmissible deduction, section 40. Expenses of payment not deductible in certain circumstances, 40A. Profit chargeable to tax, 41, and other provisions. So let us first do section 30 to 37. So the first section is section 30, which tells rent, rates, taxes, repairs and insurance for building used for the purpose of business or profession. Now rents, rates, taxes, current repairs and insurance. So if my doubt is, what if I am doing a repair and it is the nature of capital expenditure? Will it be considered as expense? No. Repair should be in the nature of revenue, current repairs, not including expenditure in the nature of capital expenditure. It should not be capital expenditure, then such can be taken as deduction. Suppose if I am the owner of the building and I am paying rent, rates, taxes, repairs and insurance, I'll claim the expenditure. If I am tenant of the building and I am paying rent, rates, taxes, rent cannot be paid here by the owner, so rent is not given here. I am paying rent, rates, taxes and current repairs, then I can claim the deduction here. Now the next section is section 31. We have seen repairs and insurance, rates and taxes, rent for the building. What about machinery, plant and furniture? So in this case, any current repairs and insurance paid for plant and machinery can be claimed as deduction for business and profession. What if my building is used for both business and personal purposes and I'm paying repairs and insurance for that? Then only proportionate amount attributable to that part of machinery used for business will be allowed as deduction. Now there will be a question, what if the tenant has paid for capital repair? Tenant can pay only current repair. Now he has done a capital repair, then what he can do is he can treat that as deemed building and he can claim depreciation on that. Now here, if partner is paying rent, firm is paying rent to the partner and partner is given building to rent to the firm, will it be allowed? Yes, it will be allowed if it is reasonable and not excessive. sorry, it will come here. Okay, depreciation. now Now, for claim depreciation, the asset should be owned by the wholly or partly by the assessee. The asset should be owned. Assessee should be owner of the asset. Asset must be used for the purpose of business. It must be used for the purpose of business at any time during the previous year. If it is not put to use, then depreciation will not be allowable, and it is a mandatory deduction. If the asset is required and put to use for less than 180 days, then 50% of depreciation will be calculated. Capital expenditure incurred by the lessee or tenant would be treated as deemed building owned by the lessee or tenant, as I told in the previous part, and depreciation would be allowed to the lessee or tenant on that capital expenditure. Now, suppose if there is a finance lease or operating lease, who can claim the depreciation? It is always the owner who can claim the depreciation. But in while accounting, we have learned differently. But in case of income tax, whether it is finance lease or operating lease, only the lessor will claim the depreciation. Now, in case of hire purchase and where the ownership passes on the last installment, in such a case, depreciation can be claimed from the very beginning, assuming the assessee is owner from the beginning itself. Suppose A has given hire purchase to B, and the ownership will be passed on the last installment. So B can claim the depreciation from the very beginning itself. Okay, what if it is partly owned asset? Then it will be depreciation will be based on the share of the asset. Depreciation is classified into two if SSC wise. One who is engaged in the generation or distribution of power, and other SSC. Generation and distribution of power have the option to use either SLM, percentage of actual cost, that is either SLM or WDV. But for other SSC they can only use WDV. Classification of depreciable assets. They have classified into 4 classes: class 1 building, class 2 furniture, class C plant and machinery, and class 4 intangible assets. Now, what are the rates of depreciations for different classes? For class 1 is buildings used for residential purpose except hotels and boarding houses will be 5%, which are not used for residential purposes 10%. Building acquired after 1st September 2002 for installing machinery and plant forming part of water supply project or water treatment system, and which is put to use for the purpose of providing infrastructure facilities. In such a case, it will be 40%. Temporary erections and wooden structures 40%. Furniture and fittings will be 10%. Motor cars other than used in the business of hire acquired from the period 23rd August to 2019 to 31st March 2020 and put to use on or before 31st March 2020 30%. Motor cars other than those in the business of hire and put to use after 1st April 1990 15%. Motor buses, motor lorries, motor taxis used in the business of running them on hire acquired during the period from 23rd August to 31st March 20 and put to use before 31st March 2020 45%. Motor buses, motor lorries, motor taxis used in the business of running them on hire other than mentioned in the block 3, that is after 31st March 2020, it is 30%. So we can see if they are using motor car in the business of hire, and it is acquired between 23rd August to 31st March and put to use before 31st March 20, 45%, other it is 30%. If it is not in the business of hire, acquired between 23rd August 2019 to 31st March 2020, put to use before 31st March 2020, 30%, otherwise 15%. Molds used in rubbers and plastics goods factories, molds will be 30%, aeroplanes 40%, pollution control equipments, water pollution control equipment, solid waste control equipment, solid waste recycling and resource recovery systems, all these are environment related, 40%. Plant and machinery used in semiconductor industry covering or integrated circuits other than block 7 above, 30%. Life saving medical equipment, 40%. Machinery and plant acquired and installed on or after September 2022 in a water supply project or water treatment system and which put to use for the purpose of business of providing infrastructure facility, 40%. Same way, buildings acquired here for water treatment system for providing infrastructure facilities, 40%. Even your machinery and plant acquired for water supply project, water treatment system put to use for the purpose providing infrastructure facility, here also it is 40%. So for both it is building and plant and machinery, it is 40% if it is for water treatment supply project or water treatment system. Containers made of glass or plastic used as refills, 40%. Energy saving devices, 40%. Renewable energy saving devices, 40%. Electrical operated vehicles, 40%. Windmills, special devices including electric generations and pumps on wind energy, all these renewable sources of energy, 40%. Windmills and any specifically designed devices running on windmills installed on after 31st March 14, and any special devices including electric generators and pumps running on wind energy installed on or before 31st March 2014, 15%. Computers, 40%. Books, 40%. Plant and machinery general rate is 15%. Ships is 20%. Intangible assets is 25%. Now, apart from depreciation, you can also claim additional depreciation can be claimed under section 32(1)(2)(a), available under the normal provisions of the act. When it is available, when new plant or machinery is acquired and installed by the SSC who is engaged in the business of manufacture or production of any article or thing, or in business of generation, transmission or distribution of power. Either it should manufacture an article or thing, or it should be used in the generation, transmission or distribution of power. Then additional depreciation at the rate of 20% of actual cost of plant and machinery shall be allowed. If the plant and machinery is used, acquired and put to use for less than 180 days, then it shall be restricted to 10% of the actual cost. The balance additional depreciation 10% will be allowed in the immediately succeeding procedure. However, following plant and machinery will not be qualified for the purpose of additional depreciation: ship, aircrafts, road transport vehicles, office appliances. Second hand machinery. Machinery previously used within or outside India by any other person. Machinery installed in office premises, residential accommodation or guest house. Machinery in respect of which whole or actual cost is fully allowed as deduction of any previous year. If deduction is already allowed, or machinery is second hand, or ship, aircraft, road transport vehicles or office appliances, or it is used for residential purposes, then it is not allowed. Suppose the power generating units are taking SLM basis, then it is not allowed. But SSC engaged in the business of printing, publishing are eligible for additional depreciation, they will be called as manufacturing of article or a thing. For claiming additional depreciation, you have to opt for old tax regime. You will not get the additional depreciation in the new tax regime. Suppose and suppose you have taken a new plant and machinery and used it for less than 180 days in the first year, you got only 10% of depreciation. Next year you can take additional 10% of depreciation. Now in next year also he should have exercised the option of shifting out of default tax regime, then only he will be able to get such depreciation. Now, how do you calculate depreciation? You must take opening WDV of the block, add actual cost of the asset acquired during the previous year, whether put to use for 180 days or more, put to use for less than 180 days, or acquired but not put to use. We should add acquired but not put to use to the block of asset, but if it is not put to use, we should not calculate depreciation on that. Less selling price of the asset, less WDV of the asset transferred in slump sale, we'll get WDV for the purpose of depreciation, less depreciation actually as allowed, we'll get the closing WDV. So this is the case we calculate the depreciation. Now for calculating depreciation, there should be two conditions. There should be asset plus there should be WDV. Now assuming sale price of the asset is 5,20,000 in case 1 and 9,30,000 in case 2. What is the opening WDV? 6 lakhs and 5 assets, 6 lakh and 5 assets. The actual cost of asset acquired is 2 lakh, 2 assets, 2 lakh for 2 assets. Now balance is 8 lakh 7 assets, 8 lakh 7 assets. First case the sale value of asset is 5,20,000 and next case the sale value is 9,30,000 but limited to 8 lakh because WDV cannot be nil or negative. And your what happens is block of asset cease to exist. So in such a case, if there is no WDV, if there is WDV also, it is a capital loss because the block of asset has ceased to exist. There should be both the condition. There should be asset as well, there should be WDV as well. There is asset, no, there is not asset, but WDV is there. We will not able to claim the depreciation, but capital gains will come. Now your asset is there, no, WDV is also not there. Depreciation can be claimed, no, capital gains will come, yes. How to compute capital gains? Full value of consideration is 5,20,000 and 9,30,000. From that we should subtract cost of acquisition 8 lakh and we'll get the short term capital loss and short term capital gain. Depreciable assets will always be short term capital asset. Block can be nil but never be negative. Now if some assets of the block of assets are there and few are only transferred, then what will happen? In the balance, taking the example, sale price of the asset is 9,10,000 and 6,20,000. Opening WDV of the block is 6 lakhs and 6 lakhs with 5 assets, and asset acquired is 2 lakh with 2 lakh 2 assets. So there are 7 assets with 8 lakh. Sale value is 9,10,000. So 8 lakhs is subtracted. Here 6,20,000. So entire 6,20,000 is subtracted. So here we still have a WDV. On this we can claim depreciation. Asset is there, WDV is there, yes, depreciation can be claimed, yes, capital gain will come, no. Now here asset is there, yes, WDV is there, no. Depreciation can be claimed, no. Capital gains will come. See here in the same way, WDV of the block of asset, see opening balance on the 1st April of the current previous year will be taken. Actual cost of asset acquired in the previous year will be taken. And from that monies receivable for the sale of asset will be subtracted. Slum sale will be subtracted. WDV of the end of the year for on which depreciation is allowable will come, and depreciation is subtracted. If the asset is partly for business and partly for other purpose, only a proportionate part of depreciation will be allowed as a deduction. If the asset is not put to use in the same year, no depreciation would be allowed, but the asset would be added to the block of asset. In case of lease, depreciation will be allowed to lesser only. For mobile phones and EPAP X and mobile phones are not computers. Hence, 40% rate of depreciation, while computer accessories it will not be allowed. While computer accessories, UPS, printers, scanners are eligible for 40% rate depreciation. Order of set off. First, current year depreciation will be subtracted, then gross forward business loss will be subtracted, then unabsorbed depreciation will be subtracted. Now, this unabsorbed depreciation can be carried forward indefinitely. Okay. See, what happens is there is unabsorbed depreciation, right? Current year's depreciation is a depreciation. If there is a more depreciation, it will result in business loss. Now, can this be set off? This unabsorbed depreciation can be set off against salaries? No, it cannot be set off against salaries, but it can be set off against any other head of income, and it can be set off against any business to which it relates is no longer in existence. Suppose I have closed the business also, and I still have unabsorbed depreciation, I can still carry it forward. Now, when the asset are put to use for less than 180 days, half rate depreciation will come, and if it is more than 180 days, full rate depreciation will come. Now see, there is a proviso to section 32(1) which says that depreciation is restricted to 50% if put to use for less than 180 days in the year of acquisition. So restriction applies only in the year of acquisition. Asset bought in 23-24 and not put to use, no depreciation will come, correct? In 24-25 used for less than 180 days also, full rate depreciation will come, because it is restricted to 50% only if it is used less than 180 days in the year of acquisition. Now see, in the previous year 23-24, year of put to use less than 180 days, previous year 2024, depreciation will be allowed in 2024 half rate. Now asset purchase in 2024 put to use is only in 24-25. Depreciation will allowed in 24-25 at full rate, because though it is put to use for less than 180 days in the year 24-25 also, it applies only in the date of acquisition, in the year of acquisition. One more thing, additional depreciation is allowable only when the new asset is purchased in the first year only, otherwise it is not allowed. But what is the exception? If it is used less than 180 days, 10% will be allowed, and next year again 10% will be allowed. Now what is terminal depreciation? Now in case of power generating units, power concerns, what happens is, okay, in case of power concerns, what happens is, if asset is sold, discarded, demolished or otherwise destroyed in the previous year, other than the previous year in which it is first brought into use, it should be under the previous year where apart from the year it is first brought into use. Okay, so it is brought to use in 2024, but in 24-25 itself the asset is discarded, and we are getting either scrap value or sales value. Whatever the sales value we are getting is less than WDV. So now WDV minus sales value. We'll get a WDV, right? But it doesn't no longer exist. This no longer exists. Asset no longer exists. So this will be taken as terminal depreciation and will be charged to P&L account. Monies payable will include any insurance, salvage or compensation payable also. What is balancing charge? In case of same power undertakings, if the assets are sold, discarded, demolished or destroyed, what we receive is sales value, monies payable or scrap value if it is greater than WDV. So such difference is balancing charge, but it cannot be greater than actual cost of the asset. So the sales value, if the actual cost of asset is 100 and the sales value is 80, sales value and scrap value is 80, WDV is say 70. Now here sales value is 80, WDV is 70, the difference is 10 is to be taken as balancing charge. Now what if the actual cost is 100, sales is 120 and WDV is 70? So 100 minus 70 will be the balancing charge 30 and 20 will be short term capital gain. Now in which year this will be taxed? It will be taxed in the year monies payable becomes due. If they close the business also in the year it becomes due, then also we'll treat as if the business is in existence for purpose of calculating the balancing charge. You can see this example, the same example. The sale value is 80, cost is 100 and WDV is 70. So sale value minus WDV is 10, which is balancing charge because it is not exceeding the cost. Suppose the sale value is 120, cost is 100 and WDV is 70. Sale value minus WDV is 50. This is exceeding, see, the sale value is exceeding the cost, the 50 is exceeding the cost minus sales value. So what will happen? Up to the cost, whatever is there will be charged as balancing charge, and over and above the cost will be 20. So cost minus WDV will be balancing charge, sales value minus cost will be short term capital gain. Okay, so let's revise from the study material what we have learned till now. What is business and what is profession? Let's see what is business, and if there are any new points we'll add on. Any trade, commerce or manufacture is a business, and profession is something which requires some degree of learning, and profession includes vocation as well. Why there is a difference between business and profession? Is there any separate tax rate? No, it is only for the purpose of presumptive income provisions, where rates and thresholds are different for business and professions. What is meaning of profits? Generally, profit means profit in cash or in kind. Capital received generally are not taken into consideration while computing the profits under this head. Voluntary receipts, if any received, also will be taken as profits. Application of the profit is immaterial. I have whatever, like in case of salary also, application of what I have earned is immaterial. So same way application of gains from the trade is immaterial. Income from distinct businesses will be calculated separately, but while calculating the gross total income, all the aggregate income will be taken into consideration. Computation of profits will be done after deduction of all the amount deductible as expenses. Legality of income. See, if legality of income, if the income is illegal, still we are bound to pay the tax whether it's legal or illegal, but deduction, if it is illegal or prohibited, will not be allowed to take as deduction. Method of accounting, whatever the SSC generally follows, cash or mercantile basis of accounting will be followed. Now section 28 we have already seen. What is charged under section 20? Income from business or profession, any compensation received on modification of a contract, termination of a contract, or any change in terms and condition of the contract, then such compensation will be taxed as income from business and profession. Income from specific services performed for its members by trade, professional, or business. Incentive received on exports will be taxed as PGBP. Value of any benefit purchases received under business or profession will be taxed as business and profession. Sum due to or received by a partner will be taxed as income from business and profession, not under the head salary. It will be deemed to be business income, but exemption of share income of the partner. Any sum, whether received or receivable in kind, under an agreement for not carrying out any activity, that is non-compete fees, will be taxed under PGBP. Any sum received under keyman insurance policy as an employer will be taxable as business income. When there is conversion of stock in trade to capital asset, then fair market value of inventory will be taken as business income. Okay, what if there is a capital asset to stock in trade? What will happen? We have studied in capital gains, right? It will be taxed in the year when stock in trade is sold. FMV minus FMV on the date of conversion minus cost of acquisition will be the capital gains, and sale price minus FMV will be business income. So this is in the case of capital asset minus stock in trade. Stock in trade minus capital asset, FMV of the inventory. Stock in trade becomes capital asset and FMV of the inventory will be taken as business income. Sum received on when there is a sale of asset on which deduction under section 35 AD is taken, then if the sale is given, entire sale income will be taxed under PGBP. Speculation business, as I told, there is no actual delivery. For example, transaction in which contract for purchase or sale of any commodity including stock and shares periodically are settled otherwise than actual delivery of transfer of commodity or scrips. Now there is a deeming provision of speculation income. It says that where any part of the business of a company, suppose a part of business company is trading in purchase and sale of shares of other companies, then it will be deemed to carry on speculation business. However, this deeming provision shall not apply in case its income mainly consists of interest on securities, IFHP, capital gains, and IFOS. So in such a case, it will not be deeming as speculation business, or it is carried on by business of banking services, where the main business is granting of loans and advances or trading in shares itself. So this deeming provision shall not apply. So the business itself is to purchase and sell the shares of other company. So then it is not deemed to be carrying on speculation business. This we have discussed. Transaction not covered under speculation business: hedging contracts of raw materials, stock and shares, forward contract, trading in derivatives and commodity derivatives. Computation of gains from business and professions divided into 5. First, admissible deductions, inadmissible deductions. Expenses payment on deduction is non-deductible in certain circumstances. Profit chargeable to tax. Other provisions. Admissible deductions is 30 to 37. 30 we have seen. Rent, rates, taxes, repairs and insurance for buildings is allowed if it is not a capital repair. If the premises is used for partly in business and partly for other purposes, then proportionate part of expenses attributable to the part of business shall be allowed as deduction. Then we have seen repairs and insurance for machinery, plant and furniture. If it is used for business plus used for current repairs, not capital repairs, and insurance premium will be allowed. Okay. Current repairs of capital nature not to be allowed. Yes, that we have already discussed. Depreciation. Charge of depreciation is mandatory. Conditions for allowing depreciation is there are 4 classes of depreciation we have seen. Conditions: assessee should be the owner. Asset should have been put to use. See, asset should have been actually used by the assessee for the purpose of his business during the previous year. If it's less than 180 days, 50% depreciation will come. Use includes passive use in certain circumstances. For example, standby equipment and fire extinguishing can be capitalized if they are ready for use. The assessee must own the assets either wholly or partly. For power generating units, there is option to claim either WDV or SLM method. What is block of asset? Block of asset are such assets having same percentage and in same class of asset. Additional depreciation on plant and machinery acquired. Additional depreciation is given if a new plant and machinery is acquired by assessee who is in the business or manufacture of article or thing and in the business of generation, transmission or distribution of power, then the rate of 20% of actual cost of such plant and machinery will be given as additional depreciation. This additional depreciation will be used in the first year itself when the asset is put to use. Now if the asset is put to use for less than 180 days, 10%, half the rate will be given. In next year again the remaining 10% can be taken. Plant which are not qualifying for additional depreciation is which is used within or outside India by any other person, which is second hand, which is already there in the office premises residential accommodation. That means it should be new. Office appliances or road transport vehicles will not come, and whose actual cost is allowed as a deduction. Now in case of printing or publishing an article, it will be considered as manufacturing, and therefore it is eligible for additional depreciation. Terminal depreciation is already explained from here. Rates of depreciation is already explained. Now we'll see actual cost. What is actual cost? Actual cost is anything actual cost by the assessee minus cost made by the owner or by other persons, that will be subtracted. What will be if cash payment is greater than 10,000, then such expenditure shall not form part of the actual cost. On such expenditure, depreciation will not be allowed. Now when asset is used for Asset was first used for scientific research and where we have claimed 100% deduction, and now it is used for business. What will be the actual cost? Actual cost will be whatever deduction we have 100% or whatever actual amount incurred is deduction is allowed will be subtracted for calculating the actual cost. Now when inventory is converted to capital asset and used for business or profession, see, stock in trade is converted to capital asset and it is used for business and profession, then FMV on the date of conversion will be the actual cost of such capital asset. Asset is acquired by way of gift or inheritance. Then actual cost shall be cost to the previous owner minus depreciation allowable as if it is the only asset existing in the block of asset. Second hand asset. Suppose I am buying a second hand asset, and in that case if the assessing officer is satisfied that the main purpose of such transfer is to directly or indirectly reduce the tax liability, reduction of tax liability by claiming depreciation reference to enhanced cost, then the actual cost shall be such amount as determined by the assessing officer. Reacquisition of asset, where asset is sold and further reacquired, then the actual cost he has first acquired minus depreciation as if it is the only asset in the block of asset, or actual price in which he is reacquired, whichever is less will be the cost of asset. Acquisition of asset previously owned by the person to whom such asset is given on lease, hire or otherwise. For example, person A owns the asset, used it for the purpose of business or profession, and A has claimed depreciation on such asset. Now what he is doing, he is transferring the said asset by A to another person B. A then acquires the same asset back from B on lease, hire or otherwise. A wants to use the asset, but B wants to claim the depreciation. B, being the new owner of the asset, will be entitled to depreciation. In the above situation, the cost of acquisition of the transferred asset in the hands of B shall be return down value of said asset at the time of transfer. The WDV of A, he has claimed depreciation already, right? So this will be the cost of asset at the time of transfer. Explanation 4a overrides explanation 3. Explanation 4a says that in this case it is definitely to reduce tax liability, but in explanation 3 says only if assessing officer is satisfied, if AO is satisfied, then only it is what AO has determined will be the cost of asset. Building, previously the property of the assessee. Now I am holding a building as my property. Now I am putting it to business. Then what will be my cost of asset? Will be calculated at cost of acquisition of by the assessee as if I have used for the business minus notional depreciation. The written down value will be my cost of asset. Now this benefit of notional depreciation, this calculation of notional depreciation is only for building. For example, a car is purchased on 10th August for 5,25,000 for personal use, is brought to use professional use on 1st July 2024 by him, when its market value is 2,50,000. So what will be the cost of asset? Here the cost of asset will be 5,25,000 reduced by notional depreciation only in the case of building. So here directly we are applying the 15% on 5,25,000 only in case of building. Capitalization of interest payable or payable in connection with acquisition of asset. So when we are paying interest, and can we capitalize it to the cost of asset? No, as per the rules it can never be included in the cost of assets. Amount of duty of excise or additional duty leviable shall be reduced if credit is claimed. If we can claim the credit, then it will not be forming part of the cost of asset. Subsidy, grant or reimbursement shall not be included in the actual cost of asset. Asset acquired outside India, being non-resident, and such asset is brought to him to India, then what will be the actual cost of asset minus depreciation, notional depreciation will be calculated. Capital asset on which deduction is allowable under section 35AD. Deduction is already allowed, so cost of asset will be nil. Now what happens is, this will also be applicable in case of transfer of asset by the SSC, where SSC has claimed deduction under section 35AD. Or the previous owner has claimed 35AD. Suppose we have taken the asset by way of gift, will, or irrevocable trust. We have discussed in capital gains, right? Any distribution on liquidation of company, distribution of capital asset on total or partial partition of SHF, 100% subsidiary to holding company, or holding to 100% subsidiary company, or amalgamating company to amalgamated company, demerged company to the resulting company, or succession formed by company, or transfer of capital asset by a sole propriety concern to a company, or any transfer of capital or intangible asset by a private limited company to an LLP. Then in case of, so in all such cases, what will happen is cost of acquisition will be nil, because previous owner has claimed the deduction under section 35AD. Okay. Capital asset on which deduction is allowed under section 35AD, the SSC under shall be nil. The actual cost of any capital asset shall be nil. Now, if I have not used 35AD properly, and I have used for reasons other than specified business under section 35AD, then what will happen? The actual cost shall, whatever cost I have claimed as deduction, what happens is whatever I have claimed as deduction will be taxable, right? Will be taxable. But what happens is I have foregone depreciation, right, for this. So cost of asset minus notional depreciation allowable had the asset been used for the purpose of business since the date of its acquisition. So such cost shall be chargeable to tax, shall be deemed to be income of the SSC. Okay, I hope you get it. See, first I have taken 35AD and allowed as deduction entire 100%. My cost of acquisition was nil, so I didn't claim any depreciation. What I have foregone depreciation, I have forgone. What I got benefit of 100% deduction. Now I have not used for the specified purpose of 35AD. Now what will done this deduction will be charged to tax, right? But depreciation we have foregone, no. So entire amount should not be charged to tax. The cost of asset minus notional depreciation, whatever comes, will be as per the rates in force. The net notional book value will be charged to tax. Now this is with reference to cost of asset. WDV of the asset will be taking in separate part.